Anand Shah, and let's understand that what is the reason why markets have suddenly taken it on the chin. He, of course, heads PMS and the AIF investments with ICICI Prudential AMC. Good morning, Anand. Nice to have you back. Why are markets falling? Is it Middle East? Is it China? Is it pure profit booking? What is the root reason for market sell-off?
Very good morning. I think last 4 years have been so good that we have forgotten that markets tend to correct every now and then. So, to go back into the long history, markets used to correct 20% once in a while, maybe on an average 13 to 14 months once. It used to correct 20%, and it tends to correct on an average 10% thrice a year. That's not something which we have seen more recently. Partly because obviously very strong inflows from the domestic investors into mutual funds, which has been sort of a stabilizing effect when FIs have been more or less net sellers in last couple of years, and that's brought out some stability into the market. But nevertheless, markets have done extremely well. There are profits to be booked. And at the same time, I don't know whether it is cyclical or structural, but we have seen some slowdown in the economy. This festive season, a lot of things are expected that they would be sort of boost the economy, boost the consumption, but the early signs are not that great. So I think a little bit of fundamentals, a little bit of technicals, and to be very honest, the correction is nothing big so far. So I think a meaningful correction is what will make us more happy as the market becomes much more solid and safer as the market corrects a little more.
Sure, makes sense. But Anand, how do you brace yourself for that solid, meaningful correction? For those who are looking at the medium haul as well and, have a momentum portfolio and a core long-term portfolio, do you think in the interim, though, they need to maybe profit take and protect and keep some, powder dry for when that meaningful fall comes?
I think the best example has been SIP. I think investors have understood that equity as an asset class is not predictable, and rightly so. Nevertheless, it generates good long-term returns, and to that extent, SIP is the ideal way for investing. I appreciate there would be short-term traders, and they would have to have their stop losses very tight and very disciplined out there. But for investors, I think an asset allocation every now and then would keep them in good stead in case there is a sharp correction in the markets.
What is the best way to understand this China comeback trade? Is this like a multi-year trend, or this is more like they'd say in Hindi, Barsati Mindak?
I think it's an important now. It's the second largest economy in the world and very large consumer base. Look, India has been relatively doing well in the midst of a global headwinds. If you go back last 2 years, China has been struggling, especially the housing part of the economy is struggling. But that's the lower housing prices, the softer equity markets also means that the consumer is also been sort of taken aback. Their savings, mark-to-market losses in their savings that made sure they are not opening their purses, they are not spending. So that's a challenge that China is facing. On top of it, you had US, which was raising interest rates, and the dollar was strengthening, which was sort of a headwind for a US economy also. Now, as I see today, India has navigated the global headwinds well. Now, what I'm seeing in coming 18 months is the global tailwinds. I think US is cutting interest rates, Europe is cutting interest rates, and China is cutting interest rates. Further, the expectation is that China can further stimulate the economy. They're also saying whatever it takes. And to that extent, if these three economies were to stabilize and start moving upwards, it's a solid tailwinds for many businesses in India, especially one which have exports also. And we have seen many auto yanks and engineering companies had a drawback or a sort of softness in their export sales over the last 18 months, especially since Russia-Ukraine standoff that has happened. So I think we are watching it very closely. India is doing well, notwithstanding global headwinds, but we can have global tailwinds to the India growth story.
Anand, does it make sense to actually make some tactical decisions in terms of sector allocations? Which sectors do you think will make a faster comeback? And, this is also in light with not just the sector rotation, which is happening so swiftly, but within sectors also, there's such a jugglery of stocks.
Yeah, so I think since election, if you see there is a change in mood. Prior to elections, it was more manufacturing allied, capital goods, infra. Even within the financials, it was more PSU banks and infra lenders, whereas the rest of the economy or rest of the market was sort of subdued. What we've seen post-elections is a sharp uptick in consumer, FMCG, in pharma, in IT. So markets have turned cautious. Market have moved into defensive and sort of cut down their positions in cyclicals, in PSUs and others. I think the correction has been pretty sharp in some of those names also. So we are clearly looking at banks, which have been not subdued over the last 3 months, but even last 2 years, they have been sort of soft in terms of relative returns in the banks is concerned. So banks is something we like. Within the manufacturing and manufacturing allied businesses like power, cap goods, we've been more selective now. Again, there will be opportunities there. Within the consumer side, I think the consumer services business will have a structural tailwinds as the per capita income rises, as the number of middle class and affluent families within the country increases. The consumption tends to move from products to services, and that's where again we are closely watching opportunity.
Where do you stand when it comes to the entire commodities or metal space, given that a lot of these companies are operating at the lower end of the global cost curve? You've got, prices compared to other countries as well, like, for example, iron ore comparatively lower. How are you looking at the entire commodities and metals basket in India?
Indeed, I think the metal companies have behaved very well. They have pruned the debt, they've strengthened their balance sheets in these last 3 to 4 years when they had a strong profitability and strong cash flow. So I think the Indian metal companies today versus 4 years back are much better off. Having said that, we had a headwind of China. China consumes and produces more than 50% of most of the metals. And given that there was a slowdown in domestic economy, they were also a very large exporter of metals in last 1.5 years. And that's been a headwind that's been putting pressure on the metal prices. I think if at all, these measures that they've been taking and further measures which they can take can stabilize and kickstart some bit of consumption, growth in China. I think it would be a good news for the metal prices in general, steel in particular, which has been the most hit because of the real estate slowdown in China.
Anand, there are always some themes which are extended. There are always some themes which are which are ready to go. Where in this market do you think there are excesses, and where do you think this market it's time now to, let's say, navigate?
I think there would be again. I was actually, we were analyzing, markets have been fairly rational, to be very honest. If you see over the last 4 years, we have seen derating in many stocks which are very expensive run up to 2020, be it consumer facing businesses, be it select banks and select NBFCs. They will trading at 6 times price to book, 4 times price to book. Those all have corrected. And there was a segment of the market was overlooked completely. Metals is the case in point, but many manufacturing companies were trading below book. They have done very well. So if you ask me, the inefficiencies in the market, which were there 4 years back at an absolute valuation level, as well as relative valuations among B2C and manufacturing. That's also reduced. So market has been more rational. Market have actually punished or have not rewarded stocks which had a slower growth. At the same time, have rewarded stocks which are relatively cheap and had a superior earnings growth rate. And to that extent, excesses are very far and few in pockets, which again, it's again relative. For someone who believes these are excesses, the others can be say it's a growth. But I see pockets, especially in the new economy stocks, where the business models are yet to be proven. The cash flows are not yet there, but market is again very excited. We have seen it going through a very tough time 18 months back. But as I see today, all of a sudden, again, the market's becoming very, very euphoric about these new age companies. And the way I see the valuations are fairly absurd for the businesses where some of them not generating cash flows, most of them might not have free cash flows at all.
All right. Thank you so much for taking time out and joining in. Good chatting with you to understand your take on the markets.
There comes a time when your heart calls for you to arise. Plant your feet solid into the ground. Decide your own limits. And then break right through them. Become something more. It's my time to rise.